going to go very quickly through the monthly data. This is old stuff now. That's August data. August was an ugly month. If you look at the flip book and look at page 27, you can see the returns in the markets for August. Very dreary. The U.S. market down about 6%. International markets down more. EFO was down 7, and emerging markets were down 9. If you remember, August was when we had all the uncertainty about the Chinese currency situation. They just devalued their currency. There was concern about the GDP numbers that were coming from China, and concern about the Federal Reserve's policy, which it seemed at the time, which was to go ahead and raise interest rates. Since that time, as you know, the Fed has balked at raising rates. They're meeting again today, and the expectation is that they'll continue to postpone rate increases. That has settled the markets down. If you look at the volatility index on page 18, you can see it spiked all the way up to 40, and by the 6th of October, it was down to 19 at kind of the high end of the range of volatility that we've seen over the last couple of years. But it's come down off the spike. And the markets themselves have recovered. Where can we see this? Yeah, page 25, I think, gives you the cleanest look. Let's look at the equity markets. Russell 3000, the U.S. market in white. You can see the snapback in late September, early October. That's continued. Now on a year-to-date basis this morning, the U.S. market is almost flat as it's continued to recover. Developed markets in orange and emerging markets have snapped back as well. As I've said to you before, I think the expectation is that the heightened volatility and uncertainty will continue until it's more clear about the trajectory of economic growth, which is weak in the U.S. And the developed world, and very uncertain in the emerging world. And then, of course, as you look at areas like Brazil and Russia, it's extremely uncertain. So we're not anywhere close to confident environment economically. Good news is we're getting paid a little bit more to take risk. If you turn to page 21, you can see high-yield bond spreads, which are a very good coincident indicator of the willingness of people to take risk. You can see that the spread over treasuries has popped up to 630 basis points by early October. That's healthy. If you look historically, that's a healthy spread. In the markets, the equity markets, I think the easiest way to look at it is page 23. As you look down, the Russell 3000 pay about 14 times, 12 times in the developed world, and 8.8 times in the emerging world. This is not smooth or anything. These are modest valuation levels, particularly overseas. And we're not at a period of time where people are paying ridiculously high multiples for things. There's some ability to get paid for taking risk, which is good as long-term investors would require getting paid a premium to take risk. If you look at our asset allocation stance on page 32, you can see that the volatility has blown us around a little bit. Our ambition is to stay close to zero, or close to our long-term target in equities on the left, and in fixed income we're trying to be underweight the long-term bonds in blue and overweight the short-term bonds in gray. The markets threw us off a little bit, and we adjust the course with rebalancing. We've already done this since the time that this was passed, but we'll continue to do it on a regular and periodic basis. The performance that can be found on page 39. You look at a one-month basis, and this is an extreme month, but that's why we have a diversified portfolio. The overall portfolio down a little more than 3%, 18 basis points better than the benchmark. And you can see the details below on the pages that follow. So that's a quick look at the month. We have an education session. If there are no questions, we can bring in an outside speaker to talk about the markets. I believe it's Philip from Prudential. Robert here. Yeah.
Any questions for Scott?
Questions on the month?
Okay.
Thanks.
Sure. And let the record reflect what he said. Representative Staten Island Borough President and Hanover Borough President have a rock.
Go ahead and introduce yourself.
Sure, thank you so much. I'm Rob Felice from Prudential Fixed Income. Joining me is Pam Pease. Pam and I work on the New York City relationship. And also joining us is Robert Tipp. Robert is our Chief Strategist at Prudential Fixed Income. So for the next 20 minutes, Robert's going to give an overview on the market and the economy. So thank you so much for having us.
Okay. Thank you very much. It's good to be here. I'm going to give a quick rundown on the world economy and market outlook. There are a few topics I've been asked to kind of touch on in passing, such as commodity prices, liquidity, in addition to kind of a basic outlook. In my work as a strategist and as a portfolio manager, I'm debating economics and markets with people all day long. So feel free at any point in time, if I go off into any kind of lexicon, anything that's not making sense, by all means, give me a hand sign, stop me and ask questions at any point along the way. So let me start on page 2 in the booklet, which will not really be necessary, but you may find it helpful as a guide, which has a tableau of economic statistics for the last few years and the outlook, which is really very stable and not that interesting. There's no crashing, there's no massive acceleration in the global outlook, where growth has been a bit above 3%, and it's a little bit slower this year. As you go through a few of the countries we've included here, the US, Euro area, China, Japan, US growth has been a bit above 2% in recent years, and this year as well, and is expected to continue at about that rate. It's really been a pretty unremarkable recovery, albeit slower than many past recoveries. But the U.S. has been one of the bright spots in the world economic picture. The Euro area, which was in recession from their crisis in 2012 and 2013, has returned to a respectable positive rate of growth, 1.5%. And I'll skip to the last line. Japan, with their Abenomics, has improved things in Japan. They have a lot more to do, but it has qualitatively and quantitatively improved the situation there. China has been decelerating over time as their urbanization has continued and a lot of aspects of their economy have changed. And there's a big range of estimates of what the exact rate of growth is in China. There's a lot of debt creation going on there, and I think they've obviously done a very admirable job of managing a huge country and a very rapid rate of growth for decades now. And they continue to try to manage this, but it is a hugely important country at this point in the world economy in terms of the amount that they import and export, and so bears watching. And that kind of breaks the edge going to emerging markets, where if we went through the emerging market countries of Latin America, Africa, Russia, and Southeast Asian continent, you would really begin to see a lot of problems. a lot of stress in the emerging market countries that's arisen since the crisis, and they basically have not really recovered. They're in very difficult situations in many countries. So it is a very anxiety-provoking backdrop as the Fed is moving towards interest rate hikes in an environment where basically the U.S. is doing pretty well and the rest of the world is doing varying degrees of mediocre or badly. For investments, it's actually a reasonably good investment environment because there is moderate growth going on and there's a lot of anxiety that's priced into the markets. The problems in the emerging market countries, the fact that the Fed is going to be hiking interest rates, those things are well telegraphed. And so ironically, it continues to be a pretty good investment backdrop, including for fixed income, which is what I'm going to focus on. On page 3, I have a graph of long-term government bond yields in the United States, Germany in gold, and Japan in blue. And you can see that these yields have been trending lower. The 10-year yield on a Japanese government bond is about 0.3%. Before Abenomics, it was about 1.5%. That basically was not low enough for Japan. One of the ways I look at interest rates, and I'm not an economist, but as an investor, is as an input to the economy. And at 1.5%, the economy was not doing well enough. At 0.3%, the economy is doing okay. Europe is a similar situation where the 10-year bond was up 2-3%. After the taper tantrum in 2013 and early 2014 in the area of 2% for a 10-year German bond, that's what they call their government bond, that was not low enough for European economies. The ECB has launched quantitative easing. They're hinting that they may do more quantitative easing. The 10-year bonds that come in here this morning yielded 0.45%, so less than 0.5% on the 10-year bond. When you look at, excuse me, the 10-year Treasury in dark blue here, at 2% or so, basically our yields are very high in the international context. There are other rapidly growing emerging market countries like Taiwan that have interest rates much lower than ours, Singapore, comparable interest rates. So the world has really shifted under our feet, and the message that you're going to get from me and from our firm and our view has been that interest rates were going to come down towards these levels. That's been our view for 15, 20 years, that they will come down towards 3%. When they were at 3%, that they were going to go lower yet. And now that we're here, what's so ironic is that the things that have brought us to these levels have now created an environment where we believe these levels are going to persist and the yields are not going to go back up. Why is this? Now, some of the things I'm not going to go into in this report, which I've gone into in papers on our website, is the fact that yields used to be very low. They're below 3% the vast majority of the time in the United States, in the United Kingdom, and data going further back. And our perceptions have been warped by the 50-year period from 1960 to 2015 by demographic wave and a million other factors that I could walk you through. So we're really back towards more normal levels, and then we're extra depressed on the yield levels for reasons that I'm going to go through. So when you look at the Federal Reserve, in my view, the vast majority of participants around the table at the Federal Reserve, at a table like this, when they discuss the outlook for interest rates, are not looking at the reality of the world. They're looking in the rearview mirror, and what this graph here shows is a couple things. The dots represent, on page 4, the expected levels of the Fed funds rate of the 17 participants at the Federal Reserve's meeting. And this is as of the September meeting. The lines, yellow, light blue, black, red, for the first 3, those represent the median level of these dots, sort of an average, and how that has been coming down. And if you look at 2016, those dots, you can see there are 4 of them above 2%. That means for 4 of the participants at that meeting, they thought they would raise interest rates 8 or more times, so every calendar quarter between now and the end of 2016, basically. There are another 4 that thought they would raise interest rates 6 times, so it's 6 out of the 8 quarters. And then there are 8 more that think they will be able to raise rates 4 times over the next year. I would be surprised if they could hike interest rates 3 times between now and then. So I think the vast majority of these docs are too high, and half of them, I think, are ridiculously high. And that's been our view, and the docs have been coming down. So how can I make such an aggressive statement about these really highly trained expert economists? So if you look at the next page, you can see their forecast for GDP in the United States. And this is a curve of, at a given point in time, where they forecast growth to be. So for example, the gold line to the left is their 2011 growth projection, which in 2010 was up at 4%. And by the time 2011 was over, was down at 1.6%. And the one characteristic that these lines share is a downward slope. That basically every forecast that they come out with is too optimistic, and by the time the clock runs out and you find out the actual number, it's lower than expected. And you can see the variations have decreased, but even for this year, 2015, as recently as about a year ago, they thought it would be a 3% year, and now it's going to be a 2.4% year. So not terrible, but not as good as they expect, and you can see their pace of learning is pretty slow. On the next page, I think I'm going to get to really what I believe is the crux of the matter for the interest rates, and it's the level of debt. The world has patently changed, and there's not a widespread recognition of the impact of this. So on page 6, these lines show the level of debt in the United States. I'll tell you straight away, the pattern is extremely similar in almost every developed country around the world and many emerging market countries. So the dark blue line represents, or black at the top, the total level of debt in the United States relative to GDP. So this level is 350%. The private level is at about 250%. And the gold level, which looks really small here, is our general government debt, which was at 30–40% at the turn of the century, is now up in the 100% area. So if you consider, well, let me draw your attention to something. Between, say, 97 and 2007 or 99 and 2009, that top line goes from like 250 to 370. So that's a 120% increase in debt to GDP. Now these are income levels. Income, how much the government takes in, how much everybody takes into the economy. So for a median income American of 50,000, this level went up by 120%, that's $60,000. That's $11,000 a year for 10 years. So if an American, borrows $11,000, it's not sitting there in cash, and that's every year, right? Going up then by 50, 60 over the 10-year period. There's spending and investment out of that. And this happened at every level of the society, whether it's financial institutions, non-financial corporations to a lesser extent, individuals to a greater extent, and then eventually the government had to take on a lot of debt. So there are 2 things that I would suggest from this. The first one is that when you have debt being extended at a rate of 10% of the amount of the economy every year, your growth is much faster. And that process has stopped. So you don't have the debt creation, you have less consumption, you have less investment, number 1. Number 2, you cannot have interest rates as high as they were when the level of debt was a half or a third of the level that it is now. If somebody has 200% of their income in debt, they can carry that now because interest rates have been cut in half. But the equilibrium level for the economy is going to be at half the level it was at. And if the Federal Reserve raises interest rates, they're going to get a multiple of the income in terms of slowing down growth that they would have had in years past. And again, this has gone on all around the world, this increase in the level of debt. The next page, indicates that there is a lot of thinking going on about this. You hear a lot about Taylor rules and a lot of things that would suggest interest rates should be higher. There's also a whole academic line of reasoning that would suggest that the neutral interest rate should be around 0. This line here the Laubach-Williams natural rate of interest came out of the San Francisco Federal Reserve. So research done at the Fed by one of the sitting members on the board, rotating regional Fed presidents, basically says, you know, we're looking at this and how this has evolved over time. The neutral rate of interest in the United States on a real basis, adjusted for inflation, might be as low as minus 0.6%. Now, on those previous dot pages, all of those participants at the meeting thought the neutral rate was a nominal rate above 3% and a real rate of 2%. But one of them has done some research and shows the real rate, neutral rate isn't 2, it's probably closer to 0 or less. Someone else at the San Francisco Fed recently put out a paper in the last 2 weeks that said, actually the neutral real rate of interest might be minus 2 or minus 3. So maybe the Fed funds rate should be at minus 1 or minus 2. And so that sounds very earth-shattering. There are a lot of people sitting around that table at the Fed that talk about the zero bound in interest rates and how things change with the zero bound. But of course, there are countries with negative interest rates, right? The ECB has a negative 30 basis point rate, the Swiss National Bank minus 75 basis point, Danish National Bank negative interest rates, the Swedes negative interest rates. In fact, the government interest rate in Germany all the way out to 5 years is below 0. People pay to have their money stored by the government. So this is not new. This has been around since 1969. Milton Friedman had a paper on this. Miranda Koff-Lakota on the Fed put out a piece probably in the late 90s called Zero Interest Rates, Why They're Good and How to Get Them. So I'm setting aside, I think he was joking about why they're good, but he's putting forth that theoretically these things could be possible. And I'll suggest to you that most of those participants sitting around the table at the Fed are not fully acknowledging the world they're in, where things are, and they're of a mindset that if they raise interest rates after the dollar has gone up, and the dollar rose a lot last year, that is an absolute recipe for recession in this country that we have seen played out a number of times. And, but they are watching how the economy progresses, and every meeting they come in out, they say, so should we hike today? They say, you know, I have some nagging suspicions why we should not hike, and then they leave the meeting, they don't hike. So they're going to be moving very slowly, and they're going to be coming to that conclusion, and that is being priced through the whole market. The whole market is expecting less from the Fed than what the Fed expects to do. And the bottom line here on interest rates would be that a 2% 10-year note in the long-term treasury, the 10-year treasury, a zero Fed funds rate, is probably neutral. We don't have growth accelerating, we don't have overheating, we don't have excessive debt creation, because their monetary policy settings are probably appropriate and they don't need to raise interest rates. So as we're watching this play out, and this is a working hypothesis, right? Our job is to steward assets for people and be right. And if we see the facts on the ground change, we'll change the view. But like I said earlier, our view has been that rates were going to come down for the last 15, 20 years, and now that they're here, our view is that they're still going to stay. Now, I mentioned it was a very good investment environment. I've talked about this massive debt load and how interest rates are going to remain low. But inflation is also very low. And so if you're getting, you know, return of maybe 3, 4, 5% on fixed income assets, when you include the yield, the rolling down the yield curve, the active management value added, and the incremental spread available on some of the non-government products, returns are actually likely to continue to be very respectable. And that is because, as I mentioned, people are very confused and very anxious. One of the opportunities and signs of this is shown on page 8. This shows credit spreads on a number of non-government sectors, commercial mortgage-backed securities, corporate bonds, investment grade, emerging markets, high yield and bank loans. And the graph to the left shows a pretty big wide sweep of time the last 15 years. And on this graph, spreads do not look that high. And the reason why they don't look high is because the spreads moved out to depression-type levels in 2008. And back in 2002, when spreads, say on high yield, moved out to 1,000 basis points, that was incredibly wide for a recession. And so basically, the markets have been very volatile. For any unit of economic disturbance, there's been an outsized market reaction. But right now where we are, if you zero in or if you look at the table off to the right, the top number there shows spreads on bank loans or high yield at 552 or 662 basis points. Those are more than double the levels that they were at the tights in 2007. They are far more than fair compensation in our view for the inherent risks in these securities. And that goes for almost all of these sectors across the board. So we think the returns from at any given level of quality, whether it's commercial mortgage-backed securities or investment-grade corporate bonds or emerging market debt, that for conservative investors that pick the better names in these sectors, the returns are going to be very respectable. And the reason for that is when you travel around, you meet with investors, they're concerned about bonds, they don't want to be in the market ahead of the Fed, they have anxiety about credit, spreads are not as attractive as they were, and all of these reasons, which basically create a massive opportunity in the market. The next page talks a little bit about China. The black line here shows the accelerating rate of growth in China, so I'm kind of going away from the main outlook into a couple of topic points. The blue line below that shows a proxy for GDP, and you can see it's very noisy, and it's a little bit lower than the big black line. And so you see growth is slowing, and there are question marks about the level of growth. You know, in the end, one way or another, the situation in China is going to continue, the growth rate will decelerate, there may be, you know, crises along the way. There's a massive amount of credit being extended there, but they have a tremendous amount of resources with which to deal with those. The one thing that is a bit unsettling is that money in China, whether it's the money of foreigners, foreign businesses, or wealthy Chinese, or many hundreds of millions of poor Chinese, nobody really knows. The money is coming out to the tune of 50 to 100 to 150 billion a month. And they have hard currency reserves of $3 trillion plus, which sounds like a lot until the money's coming out at 150 billion a month. So there are strains, excuse me, that are created from that. But you know, our base case is they're going to manage all of the different pressures going on there as they have over time. Rotating, yes?
The money coming out, is that individuals' money that they're taking out of the country? And
so nobody knows. I would imagine it's a combination. Some of it is large foreign investors and small foreign investors that invest in China consistently are allowed to take out their earnings from China. So that's going on. They may be able to take out some of their investment as well, I don't know. And then I would imagine there's a whole combination of, you know, from very wealthy to not so wealthy that see what's going on there. And this is a phenomenon really across all emerging markets, where they see deterioration in the outlook, in some countries all the way to the social fabric, and they feel like if they can get some money out, they should do it. Not necessarily that they're panicked, or maybe in some cases maybe they are panicked, but they feel that they should get money out. There are also efforts by the Chinese, because the Chinese currency is not freely traded. Nobody should be able to take their money out of China, except in very narrow venues. Right? So that's part of the troubling aspect of it, is that you see that it's huge amounts of money in what is supposed to be a relatively close economy. So, so that's to be watched. It has already had a massive impact on all of their trading partners. And that brings me to commodities. An overarching cycle, I don't have a page on commodities per se. I'll tell you that over time, commodities do not tend to go up in value. They tend to lose value relative to inflation. And so the period that we saw from you know, the 90s up through 2006, 2008 of rocketing commodity prices was a really big bull market in commodity prices, an asset class that almost always has come back down to earth afterwards and declined and stayed very low for decades. Each time, sometimes a decade, often for many. So what we've seen in this cycle is that as China was ramping up, and I'll give you a statistic which is representative of the industrialization, In 2000, they probably sold 1 million cars a year in China. We probably sold 15 million in the United States, big picture. Right now, they probably sell 20 million cars a year in China, and we're still, 15, 16, 17 million. So they went from a tiny fraction to more than the US. So that, along with people coming in from farms to cities, required cement, copper, steel, coal, fossil fuels, on scales you could not imagine. A lot of these commodities, they dominated 90, 95% of the international trade. So there was a massive effort to get these commodities out of the ground as fast as possible in countries all around the world, from your Brazils and South Africas to your Australias and New Zealands. And what's happened is that as that supply is now coming out of the ground faster than ever, and we saw, of course, the United States, the great flexible economy we have, had a massive increase in oil production like you can't imagine. As those things are coming out of the ground like this, the demand has crested, and these markets are in massive oversupply. And there are a lot of sellers of these commodities that are not price sensitive. For example, if you're a Venezuela or Saudi Arabia, you are going to need to give a certain percentage of your population money to keep things intact in terms of social order. And if they're working, pumping oil, whether you get $100 a barrel or $30 a barrel, you need to carry on. And so they're not motivated to cut back on supply, despite the fact that the markets are in oversupply. And private sector actors may be going out of business. And so I'd imagine that kind of dynamic is going on in many product markets that are in oversupply. There's also an overarching theme of alternative energy becoming more attractive, and it's less visible here in the United States than, say, in Europe, but there's an overarching effort to curtail fossil fuel consumption, right? Some of the signs of which are visible here as well. So it is a storm for commodity prices. Most of the decline's probably behind us, but there's a saying about, a joke, I guess it is, by our standards, what's a stock that's down 90%? It's one that lost 80% and then lost half its value. And so energy prices are down massively, but they're still in tremendous oversupply, and you're probably going to be bouncing lower for some time. Our markets and liquidity, very briefly on page 10, which is the last thing before I was going to wrap up. There's been a big change in the markets. And I will tell you that in terms of liquidity, there's something I do know, and then there's something I can speculate on. What we do know is that when you want to trade large sizes of assets, it is not as easily doable now as it was 10 or 20 years ago. And that may be because a lot more of the world's wealth is concentrated in the dollar markets. They're the biggest, broadest, deepest markets. All the wealth that's been gained, a disproportionate amount is here. And at the same time, the amount of capital that can be applied to trading it has been vastly reduced in the post-financial crisis world. To the extent that banks were making big markets, that is over. Their trading is vastly curtailed. And so you can trade, and the markets are continuous, but as you trade, the markets will move faster for any given amount of volume. And that has created things like the flash crash. They've created much more rapid intraday movements in the market as people adjust their positions. Now, on this graph here, some of us have speculated that pre-2008, if you're looking at the distribution of changes, it was more like this red line. So there was a lot of time, a very high probability that you would have very small changes. You could trade as much as you wanted to trade. Investment banks would make very aggressive markets. But every once in a while, if there was a huge disturbance and the whole system looks like it's going to go down, everybody has a massive position to move, including the broker-dealers. And that the tails, when you look at the extremes on the left and right, they're taller. The probabilities of a -4 or a +4, and they're referring to standard deviation moves, a really big move, those probabilities were higher in that environment. The hypothesis goes that now we're in something more like this blue line, where there's a higher, lower overall center to this, and a broader amount of the time when you're going to have plus or minus 2 standard deviation moves. So anybody comes in to do a big trade, they're going to move the market. So there are a lot more days that have big moves, but at the end of the day, if there's a big disturbance and you have a 4 sigma move, a massive market move, maybe there's a lower probability of that because the positions are held by retail investors and professional unlevered investors that do not have to sell in a panic by and large. So that's the theories. You may have, and I think this is true right now where we are, there's a little bit of a less likelihood of a complete meltdown like 2008 because there's no clear visible bubble in terms of asset prices by and large and in terms of leverage on traders' balance sheets. I would say, though, you only have to think back 2 months to see the Chinese stock market, go from, over the course of this year, from like 2,000 to 6,000 to 3,000. So you have huge volatility, and to see that spill back into the United States market and have a 12% drop in the stock market in the course of about 4 days. So this part in the middle here, where you have a couple standard deviation event, it's still pretty jarring, and so I would go with the original theory, overarching, is that the markets, they do have bigger moves these days for any degree of economic disturbance. So in summary, on the last page, it's a very modest economic backdrop. It's not that bad in the United States. It's not where we'd like it to be. Anybody would like it to be, but it's not that bad. But as you go to other countries around the world into emerging markets, it's really mediocre to kind of lousy. The interest rates are likely to remain very low. Spreads on non-government securities are very high in our view, and for cautious investors, there are very good opportunities there, and the bond market is likely to have reasonably good returns. And I could comment on currencies if that's of interest, but the markets are going to provide a lot of opportunity, continue to provide opportunity for active managers, for people that have a view, that understand what's going on. There's a lot of anxiety out there, and that creates opportunity in our view. So let me stop there. I'd be happy to take any other questions. Fred.
How reliable is the economic data coming out of China?
So I think of course, the reality is we don't know, but among any number of reasonable estimates, you see a big dispersion. And so, and I would guess, there's a range, and it is a huge range. I found it a little hard to believe. Some would say, that, the official data said they grew at 5%, but according to this measure, it really contracted. It's hard for me to imagine when you have, over 1 billion actors, that the thing changes on a dime from expansion to contraction. But I think it's very hard for people to know. What I think is going on big picture, though, is that there is a real economy there that is not a command economy, it is a market economy, and the percentage of their overall economy that is a market economy is growing over time. And, my guess would be that sooner than people expect, the currency will be widely used as a reserve currency. Maybe 5 years from now, maybe less. Most people would say much more, but I think it will be pulled forward. And it will be a bumpy transition, but these things will be worked out over time. But why?
So, would you say that you believe that low interest rates will persist until there's a resumption of deleveraging? And if they're going to persist for that long, like, what do you believe, how does that kind of translate to the construction of a bond portfolio for kind of a long-dated, kind of asset owner like a pension fund versus a global aggregator like a U.S. aggregator?
Sure. So, I do think the interest rates are going to persist. Again, my perspective on rates is looking at the last 50 years as an aberration and seeing an environment that is really conducive to, tops in the U.S. in this kind of environment, a 2.5% to 3% 10-year note. But even if you had that view that we were going to have a 1% increase in rates, if you told me you had a 20-year liability and should you go short duration, I'd ask what your time frame is. It's really hard to time the bond market, and if you want to get bearish, you have to do it at the bottom of the recession. Once the Fed's going to hike interest rates, once there's been an economic recovery, it's too late. And so, you know, if you look at a 20-year average life bond portfolio that's very conservative, that might have a yield, you know, in the area of 4.5% or 5%, and you hold that for 5 years, and you've earned 25% plus some roll down these various factors, I mean, you have to have a gigantic increase in interest rates to make you wish that you had gone short duration. So in our portfolios, you know, we tend to be underweighted governments in the actively managed, you know, broad market accounts, and overweighting degrees of spread product depending on the risk appetite of the mandate, and overweight some, you know, foreign markets, so diversifying the interest rate exposure to some other markets that have higher yields and steeper curves.
Other questions? Pat?
Yes, do you think we should take our entire bond allocation and put it on the Mets?
You know, I'm about as predictably boring a guy as you might imagine, so I don't have a view on the Mets.
I have a question.
It's probably really hurting me here, but that's, you know.
If you're saying that you think the Chinese currency will be widely used as a reserve currency within 5 years, what do you think the real rate of the Chinese currency as a reserve currency is, or should be? In other words,
The real trading level?
yes.
You know, I would guess, I mean, if you look at the United States, which has been preeminent reserve currency for the last, you know,
60 years.
yeah, we've had a rate of depreciation in nominal terms. So the yen was at 360, then it was at 240, then it's at 120. So that's an appreciation, fewer and fewer yen to buy a dollar. You know, the Deutsche Mark, you know, over time appreciated relative to the dollar. And I would imagine China is ultimately going to end up being a depreciating currency. They've been allowing it to appreciate for the last handful of years relative to the US dollar, which has been a very strong currency, so it's very sporting of them to let it appreciate. They get a lot of pressure for underselling their competitors and for manipulating their currency and keeping it cheap. And so I think they have maybe orchestrated a shot across the bow, where they said, we'd like to be an SDR, we'd like to be a reserve currency, and we know that you would like to see more free trading in our currency, so I'll tell you what, we'll free the trading the night of August 11th, you know, Western time, and we'll see how it goes. And when they opened the floodgate and the money poured out, the currency went down. And so that was a message to the rest of the world that they're going to open up and they're going to liberalize, but that the actual natural market forces may push their currency down, and that while in the distant past they may have artificially supported the depressed the currency, in more recent years they're probably artificially supporting it to the benefit of their competitors. So my guess would be that it's going to depreciate intermittently in short, small bursts like we've seen this year over the next handful of years, maybe a couple percent per year.
And do you think that that will, every time that happens, it will send a shock across the global markets the way it happened in August?
I think the next few years are above average in terms of risk in China, because there's a lot of debt creation. Their financial institutions are not really ready for aggressive amounts of money to flow in and out of the country. And so I think it is, you know, it's going to be, you know, a risky, volatile transition.
Yeah. Blair?
Yeah. So your points about the outflows of capital out of China, you know, we see it in New York, we see it around the country in terms of increasing investment in real estate, pressures on real estate and industry. At some point, though, if the economy in China falters and there's a decrease of production, lowering of higher inflation, at some point the individuals there or corporations may decide to pull money back out of necessity. Or do they leave it? I mean, how does that impact the rest of our portfolio in the way in which we look at our domestic investments?
Yeah. The amazing thing is, you know, the world markets are incredibly deep. And so they've probably pulled, you know, $300 to $500 billion out of the U.S. Treasury market, and it really hasn't made a dent in the market for people that trade treasuries, they can see treasuries have maybe cheapened by 0.1% relative to swaps and federal fund-based swaps. So very small deviations there. I am curious to see, and it has occurred to me, are we going to see this impact on real estate prices? Because that's one area where apparently money is coming out, people buying real estate and buying aggressively, which suggested they're incredibly concerned, not concerned about the return on the money, but simply getting the money out. But I've also heard, not widely, I don't have many contacts of this race, and they said, yeah, they took money out of China and they put a down payment on something a year ago, and now it's time to close on this, and they can't get the money out. So, I have a feeling, the Chinese are aggressively working to control these things. And you see all the areas where they've opened up avenues for money to travel. They're very small, so I think they can try to control it. So far, it doesn't appear to have created, any major dislocations, that I can see. But I would guess it is, going to have some modest impact on the rest of the world, and it's negative. There's another major variety of liquidity drag, because that's basically what happens is, it's a shuffling, right, of money. And another aspect of that is the Federal Reserve is threatening to raise interest rates, but they're also, many of them threatening that after they raise interest rates, they're going to let their portfolio run off. And if their portfolio runs off, the federal government has to issue more bonds to raise the money to take the Fed out, which is then a draw of liquidity out of the system. So that's something you'll hear more about too. So a lot of risks out there, and all those things point to basically a need for lower interest rates to sustain growth in the rest of the world. Now,
So among the BRICS, in terms of the economic outlook, would you say India, I guess, would have a brighter spot?
yes. India and China. The situation in India is like there's some reforms going on there, but the situation is incredibly difficult to change and is lacking some of the dynamism that China has had. So the rate of change there is going to be incredibly slow, and they have a lot of challenges. But does it look like a relatively clear shot, say, compared to Brazil? Yes. They have massively levered up, and the commodity business is kind of eroded from under them. They have a massive fiscal deficit, which means in this, and now they're in recession, with super high interest rates to defend their currency, which means they have to raise taxes and cut spending when they have no political cohesion. So they're really in a tough spot. Russia, ideally when commodity prices were running really high, would have diversified their economy into more areas, but they didn't. They're very energy dependent. Price of energy is incredibly depressed. And so their outlook is really not very good, and arguably some of the politics of their geopolitical activities over there are an effort to distract the average Russian, quite successfully from what's going on with the economy, which isn't good. That's Brazil, Russia, and then India and China, look like the brighter of the two. And the Chinese one, looks, more volatile, more fragile, and so on. But in the long run, they've done, a much better job relative to India over time, it seems like. But
Yeah, I know you're a bond guy, but with relation to the equity markets, if more people come around to your thinking that interest rates are not going to go very high,
yeah.
do you think that's going to be positive for the equity markets, or we've seen that in the last 6 weeks?
It is, it's good for bonds, it's better for stocks, and it's better for real estate. Because they're pricing relative to the level of interest rates, and there is not a widespread buy-in that the risk-free rate of interest that you should compare the stocks to is going to be really low for a really long time. And the benefit for multinational companies is the fact that they can borrow where the money is cheapest, they can sell wherever there is growth, they can buy on the ground factories where the wage productivity situation is best and here are their increments, inputs, this is going to put where they're cheapest. So that's a very good backdrop for developed country multinationals, which probably have done a better job of investing in emerging markets than emerging market companies themselves. So I think it is a very good environment, continues to be a very good environment for equities. That's also been our view, and very good for the other asset classes like commercial real estate.
Any other questions? Okay, thank you very much for coming.
Thank you.
Do we let the record reflect that the Bronx Board President?
There you go. You're gonna do this too. You want to sit down there?
Okay. Scott, we just need a minute because we're making some more copies of this handout.
Okay.
next.
And John Dorsey is going to do the next presentation on
Okay.
procurement. So I'm going to move over here.
We're making copies now.
Thank you.
Cameraman's back. Back.
Did you break the camera?
Why, thank you, Mr. Adams. So should I commence, or are we still waiting?
Did everybody get a copy of the handout? Okay, sure. Go for it, Tom.
So, in response to a trustee request at the last meeting about the procurement process, we pulled together a handful of slides to talk about what the process is, so that hopefully for those of you who are not familiar with the process, you'll become a little bit more familiar. This is really meant as a high level, but I'm happy to take questions as we go and just kind of walk you through the basics of the procurement process, which governs the public managers. So most of your fixed income portfolio, majority of your equities portfolio are covered under this type of procurement process. So basically, all of the city's procurements are under the auspice of the Policy Procurement Board, which is a government agency that's composed of 3 mayoral appointees, 2 controller appointees, and they basically set all of the rules for procuring services for the entire city. Now, prior to about 2012, it actually started a little bit before then, but as of 2012, the process that was used to hire investment managers was the same process used by the city to procure pencils, to procure light fixtures. There was no delineation from that process towards how to deal with investment managers. It was a straight line. And one of the things that was reviewed was this concept of changing the approach to hire investment managers. It's a unique role that the city does. It's not like buying a box of pencils. So what happened was the boards approved for the controller's office, specifically the Bureau of Asset Management, to engage in a process which has become what's known today as the innovative procurement process.
Known today as the,
Innovative procurement process. Innovative in terms of government, I don't know if it's innovative in terms of the world, but it's the process that we use today. And how it originated was actually not just going to the Policy Procurement Board and asking them to change the rules, but basically we actually did a study where we did do a search, or actually I think it was 2 searches, prior to the adoption of the rules to prove that this system would be viable and would work, and actually compared the statistics from the searches using innovative to past searches using the more arcane RFP process. What it basically did was actually cut down the time that the Bureau of Asset Management needed to look at investment managers. And I'll get into that in a couple of minutes. So the process was basically designed to limit complexity, make the system more transparent, and let all of the investment community know how to do business with the city as far as public equities goes and public fixed income. And what this has done is it has made us more nimble. I'll give you an example. The time to do an RFP in the past was somewhere between 9 and 12 months. And I've been here 13 years. I've watched the process develop into what it is today. And for a long period of time, it took us a long time to go hire a manager. And that was a plain vanilla manager, if you will. And we would go out into the universe, and it would take a very long time to do it. And we've cut that process down. I don't have the statistics in front of me, but it's 6 to 9 months we can procure a manager, where it used to be, much longer time. And that's start to finish. So, the best way I think to illustrate what it is that the innovative procurement is, rather than just tell you it's, section 3-15 of the city procurement rules, is to kind of walk you through what it is, what the board's role in it is, because you are certainly an important player in this, and what the role of the various stakeholders is. So if you turn to the last page of the presentation, this is just a way to kind of show how this all evolved. So first and foremost, even before we get to this process, either the board, the investment staff of BAM, the consultants have identified a need for an investment manager. Now that need could be triggered by a contract expiring, a new type of investment that the city thinks is, or the boards collectively say, that would be something that we should put into our asset allocation, and we've done some study on it, and we think that that's a good place to invest. Any one of those things can trigger the board's desire to do a search, basically. So what would happen? The Bureau of Asset Management would let the board know what the scope's going to be. I think you've seen one or two in the last couple of months where we've sent out a scope identifying what characteristics we're looking for for an investment manager. Basically, we make sure that those are written in a way that we encourage as much of the marketplace as possible to enter into the process. And that leads us to how do they enter the process, which we all spell out in the solicitation. So in the solicitation, not only do we tell people what we're looking for, we tell them how they can get onto the radar. And what's unique about our program is, and unique about the construct of the city, is we've created a system where each of the retirement systems that's participating in a search will have their consultant, and in this case Callan, open their databases and allow managers to populate the databases with any information that they think is pertinent to their problem. Now, what's important about this is there's no fee for a manager to enter their information into Callan's database or into eVestment Alliance, which some of the other consultants use, as well as the Bureau of Asset Management. And we encourage managers of all sizes and all criteria to populate those databases. And that's not an advertisement for those databases, it's simply the fact that those are the databases that we use for our procurements. So once these managers have populated these databases, we ask the general consultants to do a review of a particular universe as identified in scope. And what will happen is the first pass, if you will. So in this case, Callan, and I'll let them expand at any point that they'd like to expand on this, you know, we'll go through their database and identify managers that they think would go to the next level and require a little bit more due diligence by either BAM or by Callan, and provide to the Bureau of Asset Management a comprehensive list of the managers that they think meet the needs of the city based on the scope, and would be a good place to start their review. So in the past, and I just want to explain why that's important. In the past, we would do a solicitation, and some of you who have either worked in the controls office for a very long time, or have been with the city a long time, know the process. You know, we used to get boxes of RFPs that would come to the controls office. Not all of those would meet the criteria that we were looking for, but we had to review them. And what that did was take away essential time that the staff could use to just look at the managers that actually met the qualifications. And what this has done is eliminate that, you know, one box of 100 proposals coming to the Bureau of Asset Management to sift through and figure out that only, you know, 80% of them meet the minimum criteria, and without the minimum criteria, can't move forward in the process. So what that's done is it's cut out that whole section of the process, which really gets to the point where BAM can now focus on what's important, and that's the managers that have met the minimum requirements. So what happens once somebody's met the minimum requirements? Callan will produce a list of a short list, if you will, of investment managers that they think are a good fit for NYCERS, as well as the consultants of the other retirement systems. All of that information gets provided to BAM. BAM will then take all of those lists and compare them against each other. If a manager is on one list but not the others, it provides an opportunity for BAM to say, hey, how come they found the diamond in the rough and you guys didn't? Or what it does is say, okay, somebody's on 4 out of the 5 lists. This is something that is, you know, they all found a good manager. So what's going to happen is once you get all those 5 lists, if a manager is on multiple lists, they in essence become a short list for BAM to do a deeper due diligence on. So what does that mean? So that means that BAM requests additional information from the manager, ultimately meets with the manager, understands their process, understands their philosophy, looks at all of the things that are identified in the scope. The organization of the firm, performance, all of those criteria. After they've done their extensive review of that short list of managers, they come to the board and provide a final recommendation to the trustees. It's at that point that the ultimate decision on who to hire and who to select is before the board. Now, at any time during this process, whether we're doing interviews or whether we're talking to managers, we make sure that if anybody has a question that they have for any of those presenting managers or proposed managers, they have an opportunity to ask those questions. We like to make sure that the process is such that the board feels that they're also part of the process and not just getting this final document at the end of the day. So I think it's important for us that if there's a breakdown in communication or in these lines of communications, that the board let us know, and that's something that we can always take back to our office. We're always constantly taking this process, which we think is a good process, and trying to make it better. As long as it's within the confines of that section 3-15, we're doing everything we can to hone this process, make it better, make it more nimble, make it opportunistic, and make sure that we get a good pool of managers to review. And I just want to say one last thing, because I know that it's important to this board particularly. We've gone out of our way when we do this solicitation to not just put it in the city record, but also to to put it in other publications that reach out to the WIMBY initiatives and to any business that fits the criteria of our search. So we haven't just limited it to putting it on our website and that's the end of the day, but we've put it in industry-wide publications, we've tried to comb the universe, and we've tried to make this a process that we think that any firm, regardless of size, can participate in and be evaluated. So I think that that's a very high-level approach to the system. I hope that that's helpful and answers the questions that the trustees had about what the process is. And I'm happy to take questions. I just want to note that a couple of the asset class heads are here that may also be able to answer some specifics at this time. Please.
John, if I can add, I think it was circulated, but there's very good news around what we call the graduation policy. So the PPB board recently approved and finalized our proposal for the graduation policy.
Yeah.
Tenant?
Yes. So the process you described in section 315.
Yes.
It's more about a methodology by which you award. It's not you're not supplanting PPP rules. So my issue was, if you have these investment managers that you procure businesses with, enter into a contract, why is there, for instance, no language when they're derelict in their duties, so they go 5, that you have a right to pursue liquidated damages, for instance, as you would do with any vendor?
So I don't know if I completely understand the direction that you're going.
Expand.
Please.
Most boilerplate language that is produced under the law department for vendors who are doing business with the city of New York who are contractors have a part that if that vendor doesn't perform, that there's liquidated damages that the city could pursue for lack of performance. I'm not talking about a bad investment. If you have an investment manager who's found guilty of some wrongdoing, why are we pursuing it? Through the contract. Why are you not, for instance, putting something on Vendex? I don't know if Vendex is something you require, that this was a bad actor and the city should really consider that in the future. Why are we not debarring contractors, business manager, investment manager, who are at the end contractors, as the way we do with any other vendor in the city of New York?
So we do use Vendex. So let's just get that on the table. When it comes to investment managers, we're looking at the time of procurement and even post procurement. We're constantly looking at those managers, and if we find that there's a bad actor, we will make the board aware that we've found a bad actor. As far as the specifics of the contract, I would have to defer to the law department because I don't know enough about the Ms. Vickers?
And maybe we can circulate our side letter, because I think there are really clear protections like that in the contracts that the controller's office, Office of General Counsel, and the outside lawyers negotiate with the managers that have gone through this process. So I don't know if John or Alex want to sort of talk about some of the typical remedies and sort of what might be in those side letters. If you can give any examples, but we do have those types of things, I think, baked into our negotiations with the manager.
Well, this doesn't matter from as a trustee. I never heard it pursued. So if this language exists, could somebody tell me where we've actually used the power of this language?
Under what circumstances?
Under the circumstances of a manager that you hire that doesn't perform or gets indicted or something to that effect.
I'm not aware that we've had a situation.
Yeah, and I would
like that.
say that maybe we could talk in executive session, because
Then can I ask this question? You said you use Vendex. Has there ever been a negative report in Vendex for any of your investment managers?
I can't say that there hasn't been. I don't have a Vendex report in front of me. I do know that we do fill out, that it's commonplace for us to fill out Vendex forms. I'm not aware of any situations where anything's popped up, but I don't have a report in front of me. I'm happy to go back and look and see if there's anything that would.
Could you please check up with many people since this innovative process was put into place? How many times you reported to vendors? Any investment managers that has not done or you have some concerns with?
And again, you know, what's baked into the contract is the ultimate penalty for underperforming or managers that we lose confidence in, which is that we fire them. And, you know, within here, there's the termination report in your board packet, and we can talk about individual managers in executive session. But, you know, from time to time, that is, you know, the final remedy, if you will, that, you know, our staff uses, that they employ in order to make sure that we're getting what we want from our vendors.
Right, but if you fire the managers and they come back sometime later, and maybe not under your jurisdiction, to another controller, how are we as trustees or who does the due diligence to make sure that those who performed poorly before were fired don't come back? Usually that's done through amendment reviews, I understand.
I think it's a different process for us because, you know, we have the outside consultants, we have the professional staff within the Bureau of Asset Management. You know, I'm looking at John Merceberg because, you know, he has been the guy in U.S. equities for a number of years. So if under his watch a decision is made to let go of a manager, then I think it's a very, very high bar for that manager to come back even under a different controller. Is that?
Yeah, in public equities, we really haven't had that situation you described where someone is terminated and comes back a year or so later.
I'm not talking about your tenure. I'm talking about if somebody underperformed their previous controller or a previous board in 07 and then decides to reform themselves and make a pitch and come back now. How do we know that this was a bad actor before? So how does that happen if there's no review prior to? I'm asking the question. I'm not assuming the answer.
The staff at BAM would know the institutional history. Callan would know the institutional history. We would vet them like any other manager if they're in the process. Yeah, it's.
And I think it's important to note that a bad product doesn't always mean it's a bad firm. So it's particularly in the investment community, it's common for an investment firm to have multiple products, some better than others, obviously. And you know, that's why, particularly when we do a search, we're looking at all of those factors. We're looking at, is the organization sound? If it's not a sound organization, then that's probably gonna knock them out of the box. But if they have if they have a good organization, but they have poor performance, you're not gonna see them in the final. But I just want to make sure that we understand that there's a difference between the two issues. There's certainly bad actors in the investment community, and we try to stay far away from them. And then there are you know, just bad products that, you know, that either they changed their philosophy midway through our investment and we felt that wasn't the right place to be, and we bring those to the board and ultimately, you know, would recommend terminating them if that were the case. So we do have some remedies.
Last question. You've talked about transparency to this new process. Maybe I missed it, but I understand the part of streamlining and reducing the length of procurement. I just didn't get quite how the transparency was improved since you were no longer part of a normal RFP process. You're not advertising it the same way.
So I think it's a great question. I think it's a great question. So in the past, one of the biggest criticisms was that we would do a solicitation. It would be in the city record, and nobody would know how to send in the you know, where it was going once they sent in their proposal. I think we've gone through great lengths with this process to indicate how you're getting to that next level. So how are you getting into that next level? You're populating Callan's database, you're populating eVestment Alliance. We make no secrets about the first step of the process. solicitations can be found in a number of different publications. We go out of our way to make sure that the universe knows that we're having a process.
It's on our website.
It's on Callan's website. That's a great point too.
Does Callan want to talk about your database a little bit?
Sure. And one other point on that particular question is that one of the steps that we have to do is to first provide a list of all the firms and products that meet the minimum requirements. And then we produce a list of who the ones that we think should move forward. And we also produce a list of, all right, of the ones that did meet the minimum requirements, why is it that we're not moving them forward? What's the reason for that? But in general, our database is owned by us, so we know exactly what goes in there. It's open to everybody that wants to participate. We do feel like this is a better procurement process because it is not relying on just some manager being able to see that there is an RFP going on and then they have to go through the onerous process of filling out the RFP. They just have to make sure their information is in the database. There's sometimes the manager may not even know that there is a search going on for New York City, but just because they have their information in the database, they're being considered for you. And then, like I said, we go through the process of first identifying who's met the minimum requirements, then doing the extra due diligence, making a list of who we want to bring forward, why the ones did not move forward, and then we participate with BAM in the ongoing due diligence and interviews from that point on.
Aaron. John, thank you so much. I mean, as one of the people who kind of remember the RFP committees and the staff having to input everything from RFPs that were submitted manually, it was a cumbersome project. And certainly, you know, increasing staff, and there were ways to shrink that, but a streamlined process, and for staff to be able to utilize it is incredibly important, and I think it gives a better product for us. That being said, there are a couple of points, I think that, I think just be good to be addressed. One is, Callan's database, clearly is important that it's open for MWEs and for everyone who really wants to have access. And I know the controls office and others have gone great lengths to ensure that. I think that's vital to this, so that there's never perceived the sense that someone has tried to access the system, but because they're not in a finite database, that somehow they're locked out of that search. Getting to the question of transparency and openness, and that we should do business with whomever is the best for the system. And so limiting the databases sometimes could produce that. The other issue, I think, that has always troubled me with this PPP rule happened a couple of years ago, and I know some people had issues with it, was the concept of this need for 2 consultants to approve on something. So we have our consultant right now, whomever that may be, other systems which are not legal entities that we have any affiliation with, in effect could veto what our consultant tells us we need to do. And there's no, as lawyers here will say, no privity of contract with the SISs of the world, the NECP, the ROCATAs. So if our consultant comes to us and says, we have found the best manager that there is, we recommend you take it. Under this process, they have to be rejected. And to me, that presents a problem. I'm not suggesting that's an issue, but it's something to consider as you think about the process, because I think we have an ultimate duty to do what we need to do consistent with our fiduciary duties, and our consultant needs to do their job, which is to give us their best ideas. So I think, and it gets to kind of the question, the issues that I think you've raised in the past when we've talked about minority managers and others, about the concept of groupthink. The idea that because Callan likes it and Rocatown likes it, somehow that's who we have to go to. But if Callan, in their expertise, happens to identify a manager that breaks out of the pack, for some whatever analytic or whatever quantitative research they've done, they've decided that this manager is going to outperform, because the groupthink doesn't allow it, we are prohibited from selecting that manager. And I think it's an issue and a risk. I'm not suggesting that, that there's an easy fix to that, but I think that it's certainly something that this board, who has a duty to select the best managers, should always be apprised of, as long as we're doing this education session.
Yeah, and I think that is a fair point. And like I said, early on in my comments, we're trying to make this process as good as it can be. And part of that is hearing feedback from the boards, not just this board, but the other systems, on things that they think we need to look at for the next iteration of this, or as we move forward. And that's not to say that there is a next iteration of this in the cooker, but at the same point, we're always, as an office and as an agency, trying to move forward and make sure that the system's as robust as it is, and that it moves better and better. So,
Thank you.
So we'll take that definitely back to the office. Thank you very much.
Ray?
I would also like, further, in fairness to BAM and the procurement process, it's not, because performance in this context is very different than any other context when assessing performance. But one of the good things in place is that BAM doesn't just look at performance month to month. They look at management changes. We track the watch list. We look at potential people leaving the organization. So even if performance hasn't changed and is productive, if in the event someone's is a potential key man provision that might come into place, even if we have a good actor who's performing well, BAM is still ahead of that. And whether it's through Callan or the individual asset class consultants, that is something that BAM is proactive on to make sure that if we're taking advantage of our contractual remedies in the event there is a key man change or something else that would, even if the manager's acting well, could be a problem down the road, we're not going to be caught off guard by it.
Can I just clarify something? I wasn't talking about performance. I was talking about malfeasance, right? If a vendor gets into trouble, gets terminated, who would have known somebody in the, say, Controller Thompson performed something poorly? How would we have known? If there's no evaluation process at the end, you just terminate the contract, they're bad actors. Right? On the normal procurement policy, when a contractor defaults because of malfeasance, there's a record of that, and it's called vengeance.
Right.
So my question was, since this is a separate process, which seems to be very, very valid and a value for us, how are you recording when those vendors or managers who perform that malfeasance are there? That's a simple question. How do you record it in this system, since it's a separate process from PPP?
I see our council has her hand up, so let me ask her to respond.
This isn't exactly related to investment managers, but I did just come to mind that there have been situations, for example, where like our custodian bank has done something that we thought was improper. And one example would be the foreign exchange issues. And then we've brought litigation to recover what we consider to have been damages. There are remedies.
I'm not asking the remedy. If I go out to Vendex right now with Mayor's Office of Contract, and I pull the name of that investment bank that you said, would I find something negative?
I'm sorry, just two questions, and then I might be able to answer.
Let's address this question.
I might be able to answer it. I just want to ask if the proposers to the procurement, as part of the process, have to do Vendex.
Yes.
Okay, so if a vendor that was proposing on this proposal had to complete Vendex, and they had been defaulted on a contract by the city agency, like the controller, there's a specific question on Vendex that asks if you've been defaulted. They would have to answer yes, and it would flag a caution in the database, so you would see it. Now, the thing that triggers that is whether or not the vendor's coming up for another award. The statute doesn't require the vendor to proactively, after they've done something bad, go report it to Vendex. They're required to do that when they're up for another pot of money from the city in the form of another contract. So in your example, if that custodial bank was bidding or proposing on a particular job with any of the city agencies, they would have to report that default. If there was a default or litigation, or if they were terminated for cause or something like that.
I'm sorry.
No, it's okay. I thought that.
The question is there is a possibility also the agency, in this case, BAM, or the mayor, or the controller.
That's an option for them to go proactively put a caution in Vendex if they want to. Whether they decide to, as the agency who's had the issue, in consultation maybe with the law department or whatever they would decide to do. But certainly an agency can proactively do that in Vendex, and they do that all the time.
How many years were you at Mox?
11.
11
Okay.
years at Mox, 3 years off the contract.
But I have,
And we'll double check, just to
Ray,
close.
don't do that.
No, I'm
Ray, don't do that. Okay, I have a right to ask questions.
no, I was, no, and
Okay?
I'm trying to be helpful. I was just pointing out
I am
that,
too.
that she's an expert at Mox, more than anyone at the table. She spent 11 years there. I just wanted you to, I was trying to be helpful. I wasn't trying to be mockful at all. I apologize if that's the way it came across.
Susanna, do
I
you
was
want
just to, try to close the loop on Vendex. I think no one here knows exactly, sort of what some of the staff puts into Vendex when, but we will double check when we get back to the office and report back. I think, we're kind of describing a process that goes above and beyond Vendex, but if the question is specific to Vendex, we will certainly get back to you when we know that information.
and just to follow up on Henry's comment, my second question to BAM was going to be whether or not there are annual performance evaluations on these contracts.
I'll let you guys answer. I think
There should be, because,
Should be. It's required.
right, so every year, there should be a performance evaluation done that's entered in Vendex as well, where you could track vendor performance. These, and if they're not, I would want to know why these contracts are not evaluated the way all other contracts are.
I believe with the BAM contracting division, they kind of run the Vendex part of the contracting, and they do solicit the investment staff for feedback on the manager, as well as different operational areas in BAM.
So they get filled out and they get put in Vendex?
Yeah, I'm not sure if that's an annual, or if it's every 3 years with the new contract. I don't know, periodically, we're asked by the contracting staff to fill out some Vendex forms
It should be,
evaluating the manager.
it should be annual under the rules, but it would be good to know, because that would also give you some more transparency as well.
But we typically don't have issues where, someone's done something illegal or broken the law. Which, kind of seems like the scenario we're talking about. It's more, are they fulfilling what we hired them to do?
Al?
The ability to populate the proprietary database gets a little bit to the transparency and to the inclusiveness in terms of expanding the universe. Because the option is there. Is there evidence that this has expanded the universe?
Yes, I mean, there's a number of different ways that we believe our database has been expanded. One is the outreach that we have with the MWBEs that we do on a continual basis.
Can I have that acronym again? NW.
BE, Minority Women Business Owned Enterprises. And then also through this process of the notice that goes out by BAM and is on our website, we do sometimes get extra firms to populate the database that otherwise wouldn't have.
So this metric in terms of percent MWB after a certain outreach, recruitment effort that's been done, to be able to see whether the efficacy of that outreach or placement or advertisement or whatever yielded some type of growth increase in the database for that particular group?
We can track it. We haven't in the past to say, okay, how many managers added their data based on the New York City procurement announcement. We haven't tracked that, but we could start doing that going forward.
We do track it in terms of the MWBE managers in the database over time, so, but not specific to the procurement.
See, what's unique about combing the universe is oftentimes managers don't even know that they're being combed for being combed in the first place. So what becomes interesting is they might find out that there's a solicitation and they populated the database, and then they get a call saying, hey, you populated the database, we want to do a follow-up and get some more information, you're being considered for a mandate, are you guys still open? That's always a big question. Sometimes you find a lot of good managers hit capacity, and the difference between a good manager and a great manager, the great manager says, I'm not taking any more money, So, sometimes you get a good manager and they say, you know what, we're right at the point where we can take a little bit more money, but not a lot. What's the mandate? So what's interesting about the process is sometimes people in the process don't realize that they're actually being, caught in that universe.
And part of our Callan Connects process is educating managers, because some of these managers are much newer to the institutional process. And so we're educating on them on how to work with consultants, not just Callan, but in general. So that's populating our database, but also other industry databases. So the outreach effort is partly assessing them and analyzing their firm, their product, but also giving them education on how to work with institutional consultants.
So I hope this was helpful for everyone, and we'll take all of the points and all the comments and questions back and
report back.
Yeah, I just want to make one comment on something that Larry Schimmel had brought up, which is the fact that you might have a situation where you have consultants other than NYCERS consultant putting forth a proposal for a manager, hiring a manager. And I remember one instance where this happened, and Callan had not given that person a plus, however one wants to say. It comes through with 4 or 3 or 2 consultants. So Callan hadn't endorsed that particular manager, but when I asked the previous representative for Callan, Mark Klein, and perhaps you were here, Bud, as well, I don't recall that part, but Mark said that because he had had the agenda prior to coming here and he had knew what was going to happen, that he agreed that this was a very good manager. So therefore I felt comfortable doing it, because in my eyes, all consultants are not created equal. But if Callan says it was good and that's our consultant, then I feel comfortable doing it. Thank you for bringing that up.
Okay, thanks very much, John. Very illuminating presentation and good discussion. We look forward to hearing back from you at a future meeting. Okay, so moving to the last item on the public agenda, resolution on climate change on page 75. I hope folks have had a chance to look at this. I'll just introduce it briefly, which is that we're asking the board to approve a resolution that essentially puts us on a path to addressing the risks from climate change that are embedded in our portfolio, and looking for ways to develop a long-term strategy that seeks to mitigate those risks. And if anybody has any doubts about climate change in the room, you could look at the front page of today's New York Times, which has a piece called "Greenland is Melting Away," with video and photos and text about the effect of climate change on the Greenland and its implications for rising sea levels, which, as we all know from having lived through Superstorm Sandy, is a direct and immediate threat to all of us here in the city of New York. So with that in mind, essentially this resolution is, first of all, asking BAM to measure and publicly disclose.
I'm sorry, measure and,
Publicly disclose
thank you.
the carbon footprint of our portfolio, which would allow us to sign on to the Montreal Pledge, which is an initiative started by Principles for Responsible Investment, which NYCERS belongs to get institutional investors around the world to do that, to measure and disclose the carbon footprint of their investment portfolios as a first step towards seeking to reduce that carbon footprint and mitigate our climate risk. And then secondly, we're asking BAM to lead a procurement process, I assume along the lines that we just had a long discussion about, to procure a specialist or a consultant with specialist expertise in climate risk assessment of investment portfolios to essentially study our portfolio and come back with recommendations about approaches that we could take to mitigate the climate risk in our portfolio, both directly in investments in fossil fuels, but in our broader portfolio as well. So that's a summary of this resolution, and I'd like to open it up for discussion or questions before we see if there's a motion adopted. Claire?
Yeah, I would just first of all like to praise the mayor's office for putting this forward and other issues that we will take up later. We don't, the Public Advocate and Public Advocate James, we do not see this as a social issue, but rather one that is prudent within our fiduciary responsibilities. The underlying fiduciary responsibilities are the duty of care, duty of loyalty, but in totality, the duty of prudence. And one just has to look at the papers, as John said, and today's papers about the Gulf states soon may lead to 170 degrees and it'll be uninhabitable. What are our investments in that region? The LA Times essay profiled research from Berkeley and Stanford that climate change will economically affect both rich and poor countries, and the cost of climate change may affect reduce 23% of gross domestic product. Those are our consumers, our real estate investors, monies that we have everywhere. That's by 2100, the year 2100. I'm not sure we'll all be here, but God willing, we will be. We must understand that there's extreme weather events, shifting rainfall patterns, ocean acidification, all of which will affect our portfolios. The Public Advocate, as you all know, has asked for trustee education and has talked about climate risk and commodity risk because these are compelling risks to this portfolio. It isn't just because it's the right thing to do to look at this, but because firms like Mercer, who just did a report, which I encourage everyone to read, called Investing in a Time of Climate Change, said that climate change is a new return variable that must be looked at. Not just because it's an ESG issue, but because it will affect all aspects of our portfolio. A 4-degree increase of weather will affect emerging markets, real estate, our infrastructure, agriculture, timber, most asset classes, and will affect most countries in this world in negative ways. The fossil fuels are a risk factor, but not just for stock prices, and I think that's something we have to understand. But therefore, the effect of carbon emissions on the destruction of industries and locations in the world where our portfolio is invested, not just because of regulation on stranded assets, the unburnable carbons, but because we as a city understand the real impact of climate change. The Mayor's Office on Sustainability has indicated that we may see 6.5-degree increases of weather at some point by 2050, and higher sea levels of up to 31 inches. That will destroy large swaths of New York City and our economic base, enabling us to pay our beneficiaries to have a sustainable city. I think fundamentally the Public Advocate truly believes the mayor is showing true leadership on this because a sustainable city is also a sustainable pension fund. And I think as trustees we have that fiduciary duty to monitor it, to understand it, and what we believe this is perhaps the first step to divestment at some point when it's economically prudent to do it once that analysis is done. So we thank the mayor for his, and John for his proposal.
Thank you. Other comments or questions?
I'll just say that the controller's office concurs with everything that's been said. We think it's a great idea, and we're sort of undertaking this analysis in a really smart way, going through the Montreal Pledge and doing this robust study to really lay the basis for fiduciarily sound facts and a robust analysis of how this will affect the portfolio, and will sort of lead us on the path, looking at the right thing to do. I think it's a good idea, and I'm very supportive of the initiative.
Pat?
Yeah, I just was wondering about having a consultant to do this other than our own consultant. Would it require someone, and are there people out there who are just specialists in this area?
Well, I think that the idea here is to do an RFP. Let me just say, we are introducing this resolution to all the 5 New York City pension funds. And I think any of the consultants, such as Callan or any of the others, would be free to bid on it. But number one, I think it's outside the scope of their duty as a general consultant. And two, I think we should open it up so that it's not just the existing stable consultants, but other consultants that are out there that either have a developed expertise in doing this sort of analysis as their sole line of business or as part of a, part of a broader.
Thank you, John.
Sure.
Yeah, and I think having a specialty consultant,
Any other comments or questions? Bud?
Yeah, I just wanted to make the comment that we'd be happy to, we're looking forward to participating in the procurement, but we did put out a handout that talks about ESG implementation and interest by plans of similar to you. I thought you might find it of interest. It's broadly about ESG, not just about climate change, but it does show that you are not alone in this endeavor, and there's a lot of plans that have the similar interest, and it reflects a difference in the survey results from 2013 to 2014, and we're going to be doing a new survey soon for 2015 or early 16, and I'm sure it's going to show that there's a lot more interest in implementation.
Were the results very different between 2013 and 2014?
I'm sorry, I can't hear you.
I'm sorry, were the results very different between
It's
2013?
about an increase of about 15%.
So more interest specifically from public funds in incorporating ESG. And for reasons related to risk and considering risk-adjusted returns within an ESG context. So there is a meaningful change. This was based off of over 200 survey respondents, of which a quarter are public funds.
Gotcha.
And
Thank you.
And that was before this latest DOL interpretive bulletin, which made it, the interpretive bulletin was basically saying that you don't have to achieve a higher hurdle to invest in these type of sustainable type of investments going forward.
Okay, Andrew?
Just want to add, building off of what Larry had said, and grounding this work, in our fiduciary duty. I just want to say it's also important to realize the enormous symbolic value that this step takes in moving the conversation along towards a more sustainable and safer future, which ultimately achieves the same outcome that our search or our research will hope to enact positive change on this issue. And I know that Borough President Adams is really, really focused on renewable and sustainable initiatives, not just in the Borough of Brooklyn or the City of New York, but just globally. And this is a really strong positive step to help further that conversation, because we can't change the conversation just by doing this study, but by doing this study, we can help move the conversation forward on a much more global level, so that all players and all actors at this level are taking a serious look at this. So we're very, very supportive of this stuff.
Okay, so I think a motion would be in order, if you would like to offer one.
So moved.
Okay, second?
Second.
Any further discussion? Okay, all in favor of the motion, please say aye.
Aye.
Opposed? Abstentions? Motion carries.
Resolution number 1.
Very good. I think that concludes the public agenda. I just want to say one more thing on camera before we debate a motion to go into executive session. Let's go Mets! Is there a motion
What Yankee fan just moaned?
I always root for New York teams.
Who moaned? There was a Yankee fan moaning, I heard it.
Is there a motion to
So moved.
exit
Executive session.
public session, go into executive session?
So moved.
Second.
Second. Moved and seconded, any discussion? All in favor, please say aye.
Aye.
Opposed? Okay, motion carries.
How
Public
many
session
Bronx
concluded.
fans do you
Take a
have?
short break.
We had some Yankee fans.